So let's get into the taxing multiplier. Sometimes instead of a change in spending, you're going to contemplate what would happen if the government changed tax policies and then use that information to determine the maximum potential change in GDP. So how would taxing impact that? Well, a change in taxes is going to have an impact on the disposable income for both households and businesses. So that's going to impact how much spending occurs as a consequence. So if we know what happens to taxes, we can then also do a similar calculation to what we did for spending. All right, so just keep in mind that when we talk about taxes, we are talking about personal taxes and also corporate taxes. So personal taxes are going to be impacting households, and corporate taxes are going to be impacting businesses. So when you get a question, pay careful attention to the way that taxes are being referenced. Are they just saying taxes? That could mean both personal and corporate. Are they just referring to personal? Therefore, that's only going to apply to households, or are they talking about corporate? So just read carefully and be able to delineate between taxes in general, personal, and corporate. The tax multiplier, these are some formulas that you need to commit to memory, is the negative marginal propensity to consume divided by the marginal propensity to save. From my experience, that formula is kind of difficult for students to remember. So there's actually an easier way for you to remember what the tax multiplier is. We do the spending multiplier, I would say 85% of the time. So the spending multiplier, you're going to be a lot more proficient and confident with. So just remember that for any of these taxing scenarios, you could calculate the spending multiplier, and just remember that when you add the two together, they equal 1. So if you had a spending multiplier of 5, that would mean that your taxing multiplier would be a negative 4. And that would equal 1. Or if you had a spending multiplier of 10, then your taxing multiplier is going to be a negative 9. Some students always ask, why is it a negative number? So it's a negative number because taxes are the money that's being removed from people's gross income, so their total income, and then after that we have our disposable income. So you want to make sure that you're using that negative number in there, and it's something that's at times students might overlook. Okay, so how would this take shape? So let's say you needed to find out what would happen to the change in GDP as a result of a change in taxes. So the formula is very similar to the spending multiplier formula. It's just the change in GDP equals the change in taxes times the tax multiplier. Okay, so let's say you had a question that said something like taxes are going to increase by $20 million, okay? How would this impact the GDP of the country? So what you would need is you would need that country's MPC or their MPS. As I told you before with the spending multiplier, more often than not, the College Board likes us to work hard. So they give us the MPC and they make us do that extra step of subtracting it from 1. So with this in mind, let's just pretend that we're doing an economy with a 0.8 marginal propensity to consume and a 0.2 marginal propensity to save. Okay, so what's the tax multiplier? Well, as I told you, the spending multiplier, we get really proficient at that. 1/2 equals 5. So you could just know the spending multiplier and then realize that the taxing multiplier is a negative 4. Or you could do the negative MPC divided by the MPS. So a negative 0.8 divided by a negative 0.2 equals a negative 4. Either way, you're going to come to this end. So the change in GDP is going to equal the change in taxes times the taxing multiplier. We said that they're going to increase taxes by $20 million. So we're going to put 20 million in here times 4. 20 times 4. We're going to have a change in GDP of $80 million. And I'm going to do one more with you because cutting taxes is typically going to be a question that you're asked as well. And cutting taxes is a little bit different than increasing them. When you cut taxes, the tax change is going to be a negative number, And the tax multiplier is also a negative number, okay? So here we go. And now that I'm saying this, I realize that I forgot that -4 there, and it's actually a loss of 80 million. See, I did the same exact thing that I warned you that students do. So by increasing the taxes by $20 million, it's kind of logical that that means that households and businesses are going to have less money to spend, and therefore this is going to hurt the gross domestic product. And that's why when you do a positive 20 times a -4, you're going to get minus 80 million. So it's a loss of 80 million in the GDP as a result of that change of taxes. So if you had a negative number there, so if you did a tax cut, the change in GDP is going to be minus 20 million times that -4. So let's say instead of increasing the taxes by 20 million, they decrease them. So you're going to very carefully remember to put that negative symbol there because we're cutting taxes. Therefore, we need a negative symbol. -20 times a -4 equals a positive 80 million. And that means by cutting the taxes, this is going to grow the GDP, thus the positive number, by $80 million. That's the maximum potential. And again, it makes sense that if you cut taxes, households and businesses have more disposable income, and they're going to spend that money on the things that they want for their households or they want for their businesses or that they need.